Today's episode on Success Documented is with Mr. Mrinal Singh. With over 18 years in the field of investment management and equity research, he has been the CEO and CIO of Incred Asset Management as well as the Deputy CIO Equities of ICICI Prudential AMC, where he's grown multiple funds and actively managed assets over 25 crores. How are you today?
I'm doing good. Thanks, Shivan.
So, starting from the beginning, you're a mechanical engineer by training. How do you end up in the world of finance?
Well, I did my graduation on the engineering side, and the first job I picked up from campus was in a German engineering firm. It's called Bosch.
Mhm.
It used to be Myco those days. But my heart always lied in the field of investing the markets. That was something that was an appeal. I worked for some time in Bosch, and then I pursued my MBA. And I did my specialization in finance, major in finance, minor in marketing. From then on, I've largely been in the domain of finance. Investing has been a very joyful and enriching journey for me. It is satisfying because that's what I wanted to do. I think I belong in the markets, and there's nothing better than being where you think you belong. Rest is your hard work, and you kind of deliver, you perform, and then career progresses.
What do you think, like, about the markets drew you to investing?
So the most important part about the market is the uncertainty that it comes with. It's about the future, and nobody knows the future. So you try to project a lot of things. In the context of our business, it's about profits, it's about stock price movements, it's about a whole lot of things. And prices do get influenced with varying degrees by various informations. But finally, they settle where the profitability settles. But in the meanwhile, there can be huge gyrations in volatility. Now, it's all what I would use a term uncertainty. So it's about investing or being in the markets is about how comfortable are you with uncertainty. You know how to deal with it. You can never fully manage it, but you need to deal with it. So if you know, if you enjoy, if you cherish that kind of environment, that kind of profession, this would be one of the most lucrative ones to be around. I will draw a parallel for something like, a sport. Let's say boxing. Boxing, I think, is on the edge of what I would call a contact sport. It's difficult to distinguish is it a sport or is it something hitting? I mean, people can brand it as violence, but it is a sport. It's a recognized sport. It is even in Olympics. There are associations for it and all of that. But it is a sport. It is about, in a way, some bit of physical contact is involved. But then it's not street fighting. That is crime. This is a sport. So being comfortable with uncertainty, trying to make sense out of it, trying to profitably gain out of it. Now, if you enjoy that, this is for you.
Interesting. And once again, since you're from a mechanical engineering background, the transition with your MBA to the world of finance must have been, drastic, complete two different industries altogether. How do you think, aside from your MBA, do you develop knowledge about stocks, the markets, things of that nature?
So, well, even engineering or any graduation for that matter contributes towards your investing capability. People can come from varying fields, and it's not only me or this geography. You see, if you analyze global successful investors, they come from varying disciplines on the graduation side. Anything from psychiatry all the way to human resource and anything in the middle. So it's a misnomer that investing requires deep financial knowledge. It does, but it is at the end of it a skill. Uh, and people come with very varying underlying, domains. Engineering in my case, maybe accountancy in somebody else's case, or economics in somebody else's case, and so on and so forth. That's not at all a impeding factor. In fact, it is an assisting factor. Why I say so? Because you do invest into a business. A business is engaged in some kind of operations. The operations might be manufacturing or services. It could be goods or anything else. So your understanding of that business can be superior if you are actually well versed about how that business or manufacturing or that service is conducted. So your graduation does help in understanding that business. Finally, you are able to quantify with your ability to, or your training in an MBA or an investing discipline, and then you make sense out of it from an investing decision perspective. But from an outside perspective, it would look like as if an engineering discipline is non-financialite, but it is actually very relevant to an investing, profession. So is any other discipline for that matter. I would say if you're investing, let's say in healthcare, even medicine as a graduation would help. If you're investing, let's say, into logistics, then it will help. Construction, maybe civil would help. If you're investing into technology, maybe computer science, IT will help. It stands as an advantage if you are being very, niche investor or bucket investor into various niche areas or sectors.
That's interesting. I think that's something that Warren Buffett also talks about, your circle of competency. And like once you study, for example, medicine, you have an extreme depth of knowledge in the field of medicine, and your investing decisions in that field would be so much more accurate and so much more, studied and decisive if you know a lot about that field. That's very interesting. So you have to think of it more as a asset to your investing journey rather than I didn't study finance, so I can't invest. People can invest from all different fields according to you.
Yeah.
Okay. And so now I think one thing that I found about you in many different places is how you grew the value discovery fund from 1,500 crores to 20,000 crores. Like, walk us through the reforms and changes you made to the fund to get this massive growth in a relatively short period of time.
Yeah, so it was over a period of 10 years. It's nice you're calling it short. Most people think it is too long, but I also think that it is reasonable, neither short nor long. But then things began 2011, 1,500 odd crores. The market was also not that big at that juncture. A huge amount of accretion that we did in the fund was courtesy the MTM. So we grew the money that we invested. And obviously, when you do well, there is incremental monies that get attracted and does invest. Ballooning of a asset of a fund is a sign of its success. But the real test is across a cycle. So what I'm happy about is that this accretion of AUM or assets happened across a cycle. And when I say across a cycle, there are three primary phases in the market. There is a bull phase, as they say, the upward phase. There is a bear phase, which is downward phase, and there is a flat phase. These are the only three phases that exist in the market. It sounds very simplistic, but it's torturous to go through any of them. And the longest phase historically has been the flat phase. So that actually wears you out. Markets are not supportive, all kinds of questions and all of that. But then if you do well in a flat phase, then obviously you can handle, other phases, at least one of those other phases well. So the testimony to asset size along with performance across cycle is what is, I think, the icing on the cake. Obviously, it required disciplined investing. It required, a lot of hard work regarding, going about evaluating businesses in a very classical way, making sense of how things could look like in the future, primary research, secondary research, tertiary research, and it is an enjoyable journey. You do all your work, it takes time, but then you make an informed decision. At times you do all the work, but you realize the price isn't that good. You wait for the price. So patience, temperament, discipline, important traits for an investor. Research, extremely important skill. And then you do that over a time and the outcome is good. People trust you with their more savings, asset size go up, and it is visible to the world.
That's interesting. Just touching upon a couple points that you mentioned. First of all, you said disciplined investing. I think that's very curious. Like, what would you call disciplined investing?
I will simply define his ability to say no.
Hmm.
I would, in my mind, the most important trait of a good investor is his ability to say no. It's very easy to say yes, makes you friends fast, gets you relationships quicker. But no is a tougher decision. And I would say if an investor is able to actually say no, that means he's thought through it. He's willing to be choosy. He's confident about what he's doing, and he's chasing something more superior. So if he's saying no to buy, that means he's chasing higher return. If he's saying no to sell, that means he knows where the business is going. He's more informed, he's done his work well. So in my mind, discipline is about, okay, I think this is where I will buy, or this is what I will buy, and this is not what I do because I don't understand that, I don't want that, or this and that. That confidence can only come when you reach a level where your understanding is deep and strong and robust. So good investors, good disciplined investors, I've seen they have the ability to say no.
And maybe a lot of retail investors don't relate to that, but as a fund manager, you must have got like multiple companies just coming to you, please invest in us, please invest in us, you know. And so you thought like just saying yes, it may help in the short term, but in the long term, it can harm my fund, harm my customers, clients, etc. And I think that would be one of the things that definitely helped grow your fund that large. Moreover, you said research is important. Of course, research is important, but what do you think would be your process? What's your research process?
Based on the audience, I would actually answer that question, articulate the answer to that. If in simple terms, and why I say based on the audience is I would go as technical as the audience can absorb.
Of course.
So let me try answering that, assuming that we are talking about a diverse audience. So let's say historically it has been seen that cement demand grows 1.2 times GDP if the GDP is growing above 6%. So you can make a projection saying that, okay, GDP is going to grow at 7 odd. So let's assume cement demand will grow at 1.2 times. You make some projections, XYZ, come up with some outcome. Now, this I would call is a interesting way to model, easy way to model, but it has what I would typically say propagation of error because you're beginning with an assumption. So a good model or a good research process would be, okay, can I push the assumptions as far as possible in my modeling, and can I reduce the number of assumptions itself? So in the example I said, first assumption 1.2 times, second assumption GDP growing X, both are assumptions. Okay, can I think about it? Okay, this is the million square feet of housing that is being created. It's a more certain assumption and has better chance of trying to do a more aggregate assumption like a GDP, which has so many moving parts. And say, okay, every square feet of housing getting created or infra getting created needs this many kilos of cement. So if I assume, okay, 20% lesser also, this is what it looks like. Okay, now let me assume things, okay, and come up with a number. So same thing, trying to get a sense of where the cement demand would look like in, let's say, 3, 4, 5, 7 years. You can take a route that I said, number one, GDP assumption, demand growth assumption, or you can say, okay, create some margin of safety, get assumptions as far as possible, as less as possible. I think the chances of doing superior outcomes is better in the second example. Now, this is what I mean by good quality research or a better approach to research. I hope I have answered. Now, research is critical. It is a building block. It is scientific. It requires rigor. It cannot be devoid of assumptions, as I said, because it's about uncertain future and you need to make sense of it. You will never get full certainty, but research will help you reduce that uncertainty. And there comes a point where okay, now this is risk reward is favorable. We can step in now. This is investing for you in simple terms.
So minimizing risk, maximizing chance of returns.
Yes.
Yeah. Okay, that's interesting. And I think you've already described some of them, but what would you describe to be your, 3 to 5 tenets of investing?
Well, my good question. I mean, I would have somebody who's worked with me longer to answer this. I just look at investing. If I have to define a word, how I approach investing is my margin of safety. That is for me the key word. I want my margin of safety, and I think return will be done.
And that's all based on your research and your, being disciplined at the same time. So all of those things tie in together to form a investing philosophy that helps you, have marvelous returns like you have.
I am old school in that. I believe in a value school of approach to investing. That has worked fine for me, has seen me through.
For the audience, could you expand a bit on that?
Oh, so I mean, can be an hour-long discussion, but
Yeah.
and it is so contested. But basically, let's simplify it. Let's call it high margin of safety. That is what value school would be. Basically, buying something at a discount to its intrinsic value. Intrinsic value is a function of future.
That's nice. Um, and as a fund manager, you would have a team of analysts under you, a large team of analysts under you. How do you manage to, incorporate different points of view? Because everyone has a different idea to the same, like someone could read the same thing, five people could read the same thing and have five different opinions on it and five different ideas to what it means. How do you incorporate so many opinions as well as your own and, you know, use all those thought processes to drive the best results in the future?
Well, two-step answer to that. First, we do want the team to have diverse opinion. Everybody having the same opinion actually frightens me. The whole idea of a team is to have diverse opinions. So we create a culture where we actually celebrate differences rather than dissuade differences. We want people to put across their different view. That is exactly the idea of team. Okay, but interestingly, it is also important that I quote this term, and this is a driving philosophy of research for us. Having a view. We don't want people to have a views. In God we trust. The rest all must bring data to us. There is no view required. Keep your view to yourself. Put the data across.
Interesting.
So having a view is where emotions seep in. No views, data. So we don't discuss views. We discuss data.
That's brilliant. What you've said right there. You know, that's interesting. So even when it comes to data, I think there was this very interesting study done. I'm not sure the name of it. I'll definitely show it to you later. But with the same data, different people derive different conclusions, and I mean
That's exactly where, so a lot of study has been done about what is the optimal size of a team or a group for a discussion. So we don't want 20 people having 20 different opinions. We want experienced 4 or 5 people to have difference of opinions and we discuss that. So data can be interpreted, let's say, in 4 or 5 sensible ways. Let's assume. So that discussion is a healthy discussion. When we stick around data, try to make sense of it. And there would be a subset that will come across which will help you in your decision making. So having a 20-member difference opinion team will lead you nowhere. Having 3 to 4 outside 5 actually will lead you to superior decision.
and when do you know like these five people they're just making it slow, the process slow, they're coming off with uh, useless conclusions, for lack of a better term. And this is just driving the whole process to be inefficient. It's not working out, and maybe you should go with your own decision. When do you find that? When does it click?
So it's the job of a leader to actually moderate the discussion in a way which creates conclusion rather than do collective time waste.
Hmm.
So it's how you define the agenda. You can just throw the data at the team and it will be a melee. Or you can actually say this data, all that is data. This is fact. Now this is the part where which we need to interpret. Okay, now let's make sense of it. So let's just focus on this, no digression. So it's the job of the moderator or the leader to drive the discussion in a meaningful way. Otherwise, it can become a melee of opinions and everybody. Then it's not only that people can get egoistic about their opinion around it. So you have to actually so moderator and the leader actually it's ideally his job to make sure that there is a not a collective time waste happening rather than a conclusion coming out of things.
And what I've seen in myself, at least, like when I'm looking at a stock, I tend to get attached to the stock sometimes. Like I've done so much research, and I come across something maybe in the annual report or something that it's like, no, this can't work out. Like this won't be a good stock to invest in. Like, how do you stop yourself from getting emotionally attached?
It's very easy. I tell all the guys, particularly young analysts that join the team, I tell them that, okay, don't fall in love with non-living things. Reserve your precious love for living beings only. Love the price, not the business. So you tell me you love the price. Don't tell me I love the company. You don't love the company because the company is not loving you back. You finally love somebody who is living. who can respond to your love. Don't love a company. We're not responding to your love. You can tell me I find the price lovely. I love the company. I mean, you keep it. We're not CRISIL or S&P. We're not here to certify this is a beautiful company. We're here to make money for our business or make money for our investors. So price makes a significant impact on what returns you deliver. Companies don't change overnight. Prices do. So it's a price that makes sense. That is what you deliberate your intelligence upon. Business, once you understand, is not going to change overnight. It will take a lot for the business to change.
Mhm. And again,
So again, this is my recommendation to you. Don't love non-living things. Don't get attached to table, chair, and
yeah, of course, yeah. No, once you say like I'm attached to this chair, people will think you're crazy. But when you say it about a stock, they'll be like, "Oh, okay, makes sense." But
it doesn't.
it doesn't.
You can only get attached emotionally to a living being, which can respond to your love. How can you get attached to a stone or a TV or somebody who's not responding to your love? It has no meaning.
Yeah, and it comes up as like some sort of sunk cost fallacy. I've already put so much time into this, like now I have to invest in it.
It's called holding bias in the investing
Holding
world.
bias, sorry,
Yeah, but then I'm trying to make it simple because again, audience could be different.
Yeah.
So the whole point is, the way I tell people is, don't fall in love with the non-living things. At least let it be a pet.
Yeah. Not a piece of paper.
Yeah, or an electronic screen.
Yeah. No, that's brilliant. So the world of investing is already so uncertain, and a pandemic like COVID could already, accelerate that 10 times, 20 times, making it even more uncertain. I believe you became the CEO and CIO of Incred Asset Management just coming out of the COVID, like after it started. So, like, what was that like? What unique implementations did you make which you wouldn't have done in any other environment, for example?
So again, the same thing that I said, don't get emotionally involved. Make your decisions quite inert in terms of respond to the data rather than respond to emotions. If you would have emotionally been influenced in COVID times, you will definitely stay away from anything and everything. Because at that juncture, life was uncertain. And investing was not even something that most people were thinking about. It was like, okay, let's get through this phase before be alive, then do see anything else. So, but then as a professional investor where people have trusted you with their money, you respond to data, you invest, markets are down, you invest more aggressively if it is very appealing, high margin of safety. Markets went up quite earlier than what I thought at that point. It's okay. I mean, these things happen. Sometimes market go up or down later. What is imminent need not be immediate. So that's okay. That is why I say patience is required in investing. But then moving to a role of a CEO, CIO coming out of COVID, it has nothing to do with COVID. It was just my progression to manage teams. My funds were doing well even around COVID and post-COVID, they were definitely doing well. I aspire to actually create a culture, create a team of people, influence investing in a more enjoyable way. That is what I wanted to do, which is where the role and upgrade to new function was facilitated.
And maybe this might be a bit personal, but do you like feel stressed sometimes that, I have these many people's assets under me. I have X number of people who put their faith in me and believe that I can, help them make money. What if I can't do it? Do you ever think about that?
So two angles to it. Uh, one, there could be a very small investor with you, and there could be a very large investor with you, and anything in the middle. So I don't distinguish between a small investor and a large investor. They are investor, they are customer. We do as good to them as we would do to our own money. That is the way I operate. It is a responsibility. When I think about, if my mind drifts that, okay, there are so many people who have trusted me with their money, it actually helps me stay the course. Anytime I feel the need that, okay, where is my customer? I go walk over to the window and see on the street people walking, and I say, some of them might be my customer. I need to do good to them. They have given me their hard-earned savings so that they can have a better life going ahead. Maybe marry their children, buy a house, some financial goal. I think I should stay on course. Do best to my abilities in the most honest form. And when I go back home, I should feel that this is the best I could do. in my capability mentally and physically, and rest is destiny.
Yeah, so if you think you're doing your best, you can't do any more. You can't do any
I don't
less.
want to feel that I went back home, there was this more I could do. That I don't want to leave on the table. I do whatever best I can do to the maximum capabilities, to the maximum financial as well as mental faculties, and walk back home.
That's interesting. Now, going back to the point of data, right? You said look at the data, and that's what drives your decisions, I believe. But at what point do you think, like, how do you find that balance between the story of a stock and the data of a stock? Because, like, at least a lot of big investors that, a lot of people follow, Warren Buffett, and they talk about numbers, but they also talk about following the story, follow what a stock is, follow it as a company, right? Where do you find that divide to drive the best
There are
results?
two sources or connections between data and story. Let's call it narrative. So the data and narrative. So the narrative can emerge from the data that has more better foundation, or the data can emerge from the narrative which actually has shallower foundation. So the first thing that you need to see is that is this narrative emanating from the data, or the data is being created to justify this narrative. You can always dissect the data to suit a narrative. Or are you looking at the data and creating a narrative? And now we believe in this. There can be a narrative. It can be only woven if it is outcome of a data, rather than you create a narrative out of some views and emotions and all of that and try to force feed some data into it.
Yeah, that's confirmation bias once
Yes. So we try to distinguish between that and stay away from confirmation bias related things.
And how do you avoid confirmation bias? Because I think that's the most prevalent bias in the world of investing. You see two pieces of
Anchoring
data.
bias, confirmation bias,
Yeah,
both of them.
yeah.
See, again, good investors are loners. If you see, they are not very easily accessible. They restrict access to you. It's not a very group job. I'm not saying team job particularly. It is a team job, but it is not a group job. Good investing is not a popularity contest. It is actually a unpopularity contest. So it's a very good chance that if you're making a popular investing decision, it's unlikely to make you any great money. It is a most great investing decisions, if you analyze them, have been an unpopular decision to begin with. So one of the most important traits of a good investor is to be emotionally detached from the decision. He should have the ability to make decisions emotionally detaching from the world. It's very, very important. You look at the legends, Sid Klarman, Warren Buffett, Charlie Munger, all of them, anybody and everybody, not so easily available. They more or less seclude themselves, operate in a data world and their own way of things. So if you are a very emotionally vulnerable personality, I don't think investing is the right thing for you. If you are a person who has the mindset of dealing with data and disconnecting emotionally and making a decision, then investing is a great idea for you.
Hmm. And with data, when you're analyzing data, at like at what point do you think it becomes damage control? I think, again, one more thing I've seen in myself, because I don't have a team like you. I don't look at many investors, but like, you know, you're just digging where nothing is to be found at after a certain point, is what I believe, at least. Like, do you have a checklist you go over? I've seen all of these things. Like, I think Monish Babrai has like a 75 question checklist. He goes through each one and he's like, if it checks at least 72 or something, I can go ahead with it. Do you have something like that?
So the way at least I go about investing is I try to understand the business and funnel out those 2, 3, 4 things which actually are the dominant levers of the future of that business. Let's say, again taking the same example, GDP growth and demand. Let's say these are the two drivers of the business. Let's say for a cement business. I'm using this example again to illustrate the point. There could be varying other things. Now, these are the only two things for which I want data now. I don't want data for anything and everything. So if my understanding of business crystallizes into a form and shape that, okay, these are the two, three things that actually are driver of the future of the business, let's just get better sense of it in terms of data. Let's not try to have sea of data because you'll only be lost in it. It will create noise. It will not help you make superior decision. So out of those three levers, let's say you might actually get good data only on two. That's fine. Let's assume something with margin of safety for third. That's okay. Let's try to make sense if it is. It might be an exercise where you do it for 10 entities and you might realize only 5 and 7 are making sense. That's also okay. At least those 5, 7 will become an investable option for you at a price. That's fine. You cannot get a sense of everything and anything in life. You have to accept that as a human limitation. You have to increase your circle of competency, yes, but there is a limit to which you can do. Live within that. So, damage control again comes from the angle of being emotionally attached. There is no damage control for the way we think about it. There is data, it is blunt, no emotions attached. The data is saying X, look at it. No damage control.
Oh, you mentioned 3 to 4 levers. I'm not sure if that was an example, but if there were actually 3 to 4 or 5 levers.
For example, let's say a business could be a consumer business. Over there, sales is the most dominant lever. So sales can be split into categories where there are, segments where they have fully penetrated. There are segments where they are under penetrated. So let's just focus on under penetrated because that is where the driver of sales will come from. So let's just focus on this SKU category, how they are going there. That's it. Remaining things are fine. So if we get this right, I think we'll get a sense of where business is going. Or if there is, let's say a business where interest rates are of significant importance. So let's just say, okay, where is the interest rate headed to? I'm just using it as an example to say, and try getting a sense of it. Or if we think that, okay, rainfall has a significant impact on, let's say, consumption of seeds or fertilizer, something of that sort. So again and again, I mean, every business has its own levers. And where is the significant influence to that lever? Try making sense of it. If it progresses, you get a pretty decent handle of it. You might be actually able to make sense. Complex, but I think we'll have to get. This requires
Yeah, of
doing investing.
Yeah. No, of course. Yeah, and about half a year ago, I believe December sometime, you made the prediction that rural consumption would dominate 2024. Uh, if you could explain a little bit of the rationale behind that decision, or sorry, prediction, and how it's panned out so far.
So I'll use a word forecast rather than prediction. Prediction is something fortune tellers do more.
Yeah, okay.
So our forecast or our data makes us believe that rural consumption has bottomed out. It's a matter of time that as the election and post-election, the government, see, it's a democracy, votes are with the masses. The masses are more towards middle and lower income. And when I say rural, actually, I mean middle and lower income largely. Those households have been largely struggling post-COVID because growth in income has been lesser and inflation has eaten away their disposable income. As and when growth happens, as and when inflation comes down, as and when the government or election rollouts happen, there will be more disposable income. It will reflect upon the basic consumption patterns of rural, particularly lower and middle income households. And the volumes right there. The higher income households in India are actually not volume provided to the business. Let me use an example of Mercedes versus Maruti. Maruti sells in the vicinity of 1.5 million cars a year. Mercedes sells in the vicinity of 18-20,000 cars a year.
This in India?
Yes.
Okay.
So I'm talking in the Indian context only. So a Mercedes doing 20% sales growth, maybe 3,600 more cars, and that would be phenomenal and all, but does not move the needle for an economy like India. It's a good economic times headline, all of that, but doesn't make an impact on the real economy. But if Maruti sells more 10% cars, that is 1.5 lakh cars more, that means 6 lakh tires and whatnot with the value chain, that shows up. So the real volume, real growth is in the lower income households. The pyramid of consumption in India in terms of volume is like this, and it's very, very steep. So the higher ticket SKUs in India are showing higher growth in percentage terms, but volume is not very significant. The lower ticket SKUs actually have very significant volumes, and that growth actually moves the juggernaut ahead. It has been lagging for a variety of reasons, and I think those have bottomed out. And going ahead in the next year, two, three, this will all reverse, and things will look better on that side.
Hmm. That's interesting. Like, a lot of people don't think the same way that you do, or at least, like, I don't think a lot of investors think the same way that you do. And in the same note, do you have any forecasts for any, future dominant sectors, at least in the next 2 to 3 years? I know it's a long time, but
So the seeds for next industrial revolution are already sown
Hmm.
between AI, drones, and things like those. I think the technology and the money and the brain power is getting invested there. Like internet, actually, in the last 20-25 years has uh, decisively changed the way we consume, the way we communicate, the way we talk, the way we conduct everything. In the next 20-25 years, the new technologies like an AI or so many other things will actually significantly impact on how we consume, communicate, conduct, all of those. So this is the place where the future belongs. It will also, so will people eat food? Yes, they're not going to eat internet or AI, but the way it was delivered to them, the way it was, consumed, the way it was marketed, those are the things that get impacted. I think it will influence that consumption and behavior in a significant way. That's a place. The world is after it, and obviously a lot, we haven't even scratched the surface, lot is going to happen. In fact, AI, the world doesn't even know where it is going, how powerful it is, what are the people are talking about controlling it rather than, so we don't know. Education could be revamped because AI might make a lot of things that we typically do in education redundant. Uh, and let's see.
And that uncertainty towards AI, do you find that appealing in terms of investing, or are you trying to, stay away from the hype because so many people are talking about it? It might potentially be a terrible investment, at least at the current moment.
It is crowded, no doubt. It is part of early stage investing as of now. I don't get it so well. I'm still watching. I'm not having a good hang on it. I find AI extremely powerful. I'm yet to see a controlled AI which can be meaningfully useful and not damaging. That could be just me not having put time to it. But I'm keeping my eyes open, but I haven't obviously invested. We'll not be able to run away from it for long. But as of now, I've not got the hang to the extent that I can deploy monies to it.
Hmm. And I presume on the same note, there's not much involvement of AI and machine learning in the workplace at this moment in terms of, investing mutual funds, etc.
In investing as such, AI and machine learning has been active for even last 5-7 years.
Uh-huh.
In trying to read, annual reports, earning calls, and all of that. ML has been active. AI is also active. Hedge funds use it in variety of ways. Has it been successful? I am not sure. I have seen that, earlier it used to be a processing speed versus investing. See, investing is not a technology or an IQ game. It is still a skill. And it is a skill. How do you deal with emotion? AI is yet to deal with emotion. The biggest hurdle or the opportunity gets created with emotional decision making in the market.
So AI kind of bypasses that emotional because, of course,
I'm not sure if AI has the capability to deal with the emotion.
yeah, yeah. So AI is kind of what you're talking about. Only data, no emotions, don't be attached. That's like what AI kind of does for
Trying to
investors.
be logical,
Logical.
trying to be fast, but that has no great advantage in investing.
Hmm. That's interesting.
But it does have a significant advantage in research.
And in your practices, at least in the past few years, have you seen AI been being used more in research? Uh,
I clearly see AI being used much more in execution rather than investing as of now. It might actually progress to investing also, I don't know. But at this juncture, I can see AI has been put to great use in the execution part of trades, the exchange, the arbitrages, the block trades. Over there, we see a lot of AI being active. AI, or let's say algos or ML being active. Technology has advantage over because it's about speed, it's about stealth. Technology has distinct advantage. Anything that requires speed and stealth, I think technology has an edge. Anything that requires dealing with emotions, technology hasn't yet got there.
Yeah, and I don't think it will for quite a while. At least I hope it doesn't, because then a lot of jobs are going if that happens, right? Just to wrap up, what would be your advice to young investors, maybe my age, maybe slightly older, people who want to at least go into the field of investing, mutual funds, hedge funds? What's your advice to them?
I think early, because investing is a post-graduation thing, you should pursue your education, pursue your passion. See, the market is very glamorous, and a lot of young, bright minds get attracted to it. What they seem to forget is market doesn't distinguish between a rookie and a experienced hand. It's like dealing with the gorilla in the room. Finally, the gorilla will win. You need to know how to deal with the gorilla for some time. So it's better to actually be well equipped before you going into the market and gorilla bashing you up. So get your education right, align with a seasoned guy and see how it works. Find your own space, deal with it. Don't hurry, because gorilla bashes very badly.
And there's going to be good companies 5 years from now, 10 years from now.
It's never going to end.
Yeah.
I mean, see, markets have always attracted the sharpest and the best minds. It will remain the case. And it's not that investors and capability to invest will anyway perish ever. It is always going, because evolution of technology, economy keeps happening. So don't go unprepared. There is very sharp set of people out there. So what is it that you have different and great that you will do better? Make sure you're there. Don't just jump into it because it's easy to jump into it.
It's easy to jump into, hard to get out of.
Yes. Hotel California kinds. You can check in.
You can check in, but you can't. That's brilliant. Okay. Yep. Thank you for sharing your knowledge today. It was an interesting talk. I'm sure a lot of young people learned quite a bit, learned when to start, when to stop, and learned a lot about your process. It was good talking.
Thank you so much. Thanks a lot, Shivan. Best wishes from my side.
Thank you.